Now, Beata Caranci. She is the chief economist and senior vice president at TD. Beata, thank you so much for joining me. One of the questions I posed to Tiff Macklem was exactly about how mortgage costs are feeding into inflation. I didn't really get a clear answer into how the bank thinks about that or looks through that. How do you, as a chief economist, think about how mortgage rates are feeding into inflation?
Well, I would agree with the answer that he gave. What he was basically saying is, yes, it feeds into the inflation. It's only about 4% of the overall basket, but it's rising at a rate of about 30% year over year. So it's having an outsized impact. But you can't just say, oh, what's inflation less the mortgage interest costs? If you did, you say, hey, inflation's only rising at about 2.5%. We don't have a problem. At the same time, you'd have to take off the things that are depressing it, that are temporary influences, such as the energy side, which because of the war that started last year with Russia in Ukraine, had led to an outsized increase in energy costs. And so the year-over-year rate of energy is also down substantially. So if you're going to take off things that are on the high end, you also have to take off things that are an aberration on the low end. And when you do that, they have metrics that are called the median CPI or the trimmed, which kind of takes off those tail outcomes. And that's still telling you that you're just under 4% on inflation, about 3.8, 3.9%. So even with those metrics, you're still saying, you know, we're 2 times the rate of inflation. And so, yes, mortgage interest costs factor in, but that is one of many factors that they're looking at. If it was only related to mortgage interest costs, then that would be a different argument. But what they're saying is, listen, we're seeing high price pressures in a number of areas, especially in discretionary spending areas, such as, you know, eating out at restaurants, airfares, and other areas like that.
I wonder, too, and maybe the bank can't say that, but that it's a feature, not a bug. Ultimately, if people have to set more aside to pay their mortgages, it's going to cool down consumer spending.
Yeah, that's ultimately the end game that they're after. I think it was very clear in the Monetary Policy Report yesterday how surprised they were by the degree of strength in consumer spending that came through in the first quarter. We're looking at almost 6% annualized, and this is after people would have absorbed to some degree, you know, the shock of interest rates rising by 100 basis points at a single meeting in the prior year, right? And we were seeing those 75, 100 basis point moves. And so to still see that degree of strength, I think really caught them off guard. And then the other point they're making is, you know, looking at the year-over-year change in prices is important, but when they look at the 3-month trend, what's happening in terms of what might be a predictive of the upcoming months, that's starting to flatline. So a lot of the progress that they were seeing is now starting to level off, and that's a consumption story that has them concerned.
And I wonder if them pushing out the date at which they expect to reach target inflation was almost like shadow guidance as to where interest rates are going, being hawkish without overtly saying we still probably need another rate hike. How do you see rate hikes evolving from here?
Yeah, so we have not put in another hike at this stage, but I think we're beyond we're past the stage of forecasting as opposed to reacting to the data. So as Tiff Macklem noted, every meeting is effectively live. Every meeting is dependent on the data that happens between the prior meeting, so in that 6-week period, and they will be evaluating on that basis. So you can have a forecast that says, you know, consumer spending should slow down by the 4th quarter of this year and into next year, which is our view. We actually think consumer spending will start to contract modestly in the first half of next year. If that forecast isn't realized, then yes, then you would have to say we probably have to see a further adjustment in interest rates. I would say when I looked at the Bank of Canada's forecast, they are more optimistic than we are in 2024. If you look at the peak impact of when interest rates really start to bite into consumption behavior, it takes about 7 quarters, and that's by their own analysis. And much of that impact won't be felt until around the 4th quarter of this year and into the first half of next year. And so that's when I think is the real critical period that if you're still overshooting forecasts, then we definitely have an issue with too much resilience on the economy where they'd have to push rates higher.
Help me understand consumer prices in the U.S. falling. That was the data that we got yesterday. Producer prices in the U.S. barely expanding month over month. China signaling it's just 1 month of data, but that they're deflationary. Doesn't this all suggest that Canada's path is towards lower inflation, that stubbornness is going to abate?
Yeah, that's in our forecast. And so it's the speed of decline, perhaps, of what they're thinking of. Is the progress occurring at the rate at which they were expecting? And they're worried about that progress stalling out, meaning I think to your earlier point that they really can't change the rhetoric away from being hawkish on the direction of interest rates. We call it job owning in the market, that if they were to signal like they did in January that they were going to move to a pause, you're going to get a drop in yields, which is counterproductive to their fight on inflation at this point. So they're going to have to remain, in terms of public commentary, very forceful in terms of how their language is in addressing inflation and keeping live the risk of an increase in interest rates in order to prevent that counterproductive move on yields dropping and then refueling demand in housing and other areas of the economy.